Good morning, everyone. Welcome to this market update for the 4th of May. There haven't been a video for a couple of weeks as I've been travelling. There wasn't a great deal going on in the markets at the time, but to kind of make up for the absence over the last couple of weeks, I'm going to do an expanded version today. I think markets are in a very interesting position and there's a lot that we can learn. So I'm going to give you a longer version, going to look at some of the bigger picture issues, and yeah, I hope you enjoy it. So let's have a look at the big picture, and what I'm talking about here in the big picture sense is how things are positioned over the next 2 to 5 to 10 years. So this is not things that will necessarily change or impact us in the foreseeable future, certainly within the time frame that most people would either be trading or investing. So to me, the biggest influence on markets at the moment is central bank policy. So I'm talking about the fact that they've been printing money in all sorts of various forms, and also the ultra low interest rates. But before we get to that, the hardest thing for investors and traders to do is to avoid focusing on the noise and being able to think clearly. And I'm in a position where I get to speak to literally hundreds and hundreds of people, and there's been this consistent theme that people are worried about government debt, and worried about China, and worried about all sorts of things that really aren't impacting markets within the time frame in which we're operating. And I know people that have stayed out of the market since the crash in 2008, convinced that things were going to fall off the rails again. Well, I mean, the US market has more than doubled in that period of time. You know, it's been one of the best trading and investing periods of all time. Yet everyone's been focused on some of these big picture issues and expecting them to actually have an impact. And yes, there are some big concerns out there, but I honestly believe that there's no way they're going to intrude on the markets in the next 2 to 3 years. Probably more like 5 years, and possibly even 10 years. So if you're worried about financial markets falling apart because of government debt, then you're focusing on something that I don't think is relevant. So really, really important is to cut out a lot of the noise and really think clearly about what it is that makes markets move. Now, central bank money printing and the really low interest rates are going to continue for several years as a minimum, and while ever that happens, markets are not going to crash. So, if that's your view, then you've just got to forget about it. You need to focus also on what I call the ideal trade or investment. Now, what do I mean by that? So to me, I look for 4 things when I'm looking at either a potential trade or an investment. I look for strong and consistent financial performance, and for those of you that follow the other videos that I do, I've elaborated in detail on what the components of that financial performance are. It's not rocket science, but it just, again, it's clear thinking, and it's sticking to a consistent approach. The second thing that I look for is that these stocks need to be able to remain in what I call the sweet spot of industry trends for the next few years. So they need to be in a sector that has fundamentally got things going in their favour. There's no point being in a great company that's well managed, but it's in a sector that is in decline. So we need to focus on sectors that are going to be the subject of positive trends in the next few years. The next thing is you need to wait until they're available either at or below fair value. There are lots of great stocks out there. They're fabulous businesses. They will continue to grow, but they're just overvalued. You look at a stock like Amazon in America. Now, that's a great company. They're going to grow into the future, and it's hard to see how anyone is going to start to impact on their market dominance. But they're just too expensive. It's just crazy to be paying the current prices, and we've got some of those stocks in Australia as well. So it's not just a matter of finding a great stock, it's the value as well. And the final thing is that they need to be available at what I would call a technically attractive entry level. And a technically attractive entry level means that you've got the overhang of potential sellers and profit takers out of the way. That minimises the downside risk and it maximises the upside. And there's certainly some very straightforward technical processes that you can go through so that you raise the odds of your success quite dramatically. Now, there are some things that could go wrong. So here are some indicators to watch. But as I said earlier, I really believe that these are things that are well off in the future and we don't really need to worry about them at the moment. We just need to keep a bit of an eye on them. First of all, junk bonds, which is the bonds issued by either companies that are a severe credit risk or by governments that are a severe credit risk for that matter as well. These yields are just at stupidly low levels. Those levels are illogical and they are unsustainable. If we look at government bonds, for instance, you get a lower return by lending your money to the governments of Portugal, Spain or Italy than you do lending it to the Australian government. Now, whilst Australia is not exactly travelling all that well at the moment, you'd have to say that Australia as a credit risk is much, much higher than those other countries. And yet people are prepared to lend their money to those weaker countries for absurdly low interest rates. So the risk does not justify the reward. The other big picture thing that will go wrong, not could go wrong, but will go wrong, but I think is a long way off in the future, is that governments cannot continue to spend more money than they raise through taxes. There is an end point to that game. It is not a forever situation. But while central bank policies remain where they are, then there's no reason that cannot continue for quite some time. Now, the end result is a continual deterioration in the currency and a deterioration in the standard of living. So all of that has an end point, but look, it could be 10 years away, it could be 20 years away. So it's not something I think that you should be focusing on. Now, moving on to the actual markets themselves. So there's a big picture backdrop. So the bottom line is I remain big picture level, very positive on markets for the next couple of years at least, and possibly longer. Now, right now, within the time frame in which we're trading and investing, there are definitely mixed signals coming out of America. These are the positives as I see them at the moment. The S&P 500 index is still holding firm despite the fact that the Fed continues to reduce their monetary stimulus by $10 billion a month. And that's a bit of a surprise. We'll have a look at that chart in just a minute. The VIX index is down to 13, indicating a fair amount of complacency in the market at the moment. Now that can be a contrarian indicator, but it's certainly not indicating that people are worried about any sort of imminent correction in the market. Otherwise, there would be a lot more insurance being bought through the process of put options. Corporate earnings, we've just completing the corporate earnings season in America, and about 70% of stocks have beaten expectations and have shown strong growth. So during 2013, global markets went up on the expectation that corporate profits would continue to rise, and that is now being delivered. If corporate profits had fallen short, then I think you would have seen a very sharp and possibly severe reaction in the market because it had already been priced in. But those earnings are coming through now, so that's underpinning the market as well. Now, there are some negative signs. Money is moving into bonds. There's no question about that, and we'll have a look at that, a key chart on bonds when I finish this slide. Secondly, we've seen, whilst the S&P 500 index has held up quite well, we've seen sharper falls in the NASDAQ index and the Russell 2000. So the broader market index is definitely deteriorating. Nearly 50% of the S&P stocks are in the red for the year. So that's saying that the S&P index is being held up because the larger stocks are being supported, but there's a lot of the market that is definitely weakening. So let's have a look at some charts. We'll start with the S&P 500. And if we pan back and take a big picture look, you can see there's been an enormously strong uptrend. If you look at the red 150-day moving average line, it's still unchanged. The index is still comfortably above that moving average line. So if you shut out the noise and just look at what the chart is telling you, then there is no change in character in the S&P index. But bearing in mind the S&P index is heavily influenced by the top 20 or 30 stocks. The only point that you could point to is that after every previous low, the market quickly went on and formed a new high. You can see every time we had a bit of a dip, the market immediately went to a new high. So far this time it hasn't happened. We've had a dip. That dip didn't even make the moving average, which indicates strength, before it moved higher, but it just seems to be running out of steam a little bit. Now, it could just be going sideways. I really don't know. We need a bit more time to see how this unfolds. And this is a weaker time of the year now that we're into starting in May. May, June, July, possibly into August is traditionally the weaker time of the year. It doesn't mean that the S&P index has to fall off a cliff. It could just go sideways in a band between, say, 1800 and 1900 for the next few months, and then recommence the uptrend. That's entirely possible. Let's have a look at the NASDAQ index. Now you can see that whilst it also hasn't broken down yet, the moving average is just starting to just roll over just a touch, and the NASDAQ is further away from its highs than the S&P is. So definitely more weakness in the NASDAQ index. Let's look at the Russell, the Russell 2000, excuse me. The same chart pattern there, but probably even a little greater. The prices of the index now are below the moving average starting to flatten out, and the prices are well below their peak. So there's no question that the broader market is weakening in America. But will it continue to weaken? That's the big question at this point in time. Now, I mentioned the bond market. This is the 20-year Treasury bonds, and when the price of bonds go up, then bond yields are going down. And if the price of bonds are going up, then that means that money is flowing into the bond market, and almost by definition, that means money has to be coming out of the stock market in order to go into bonds. So there's no question we had a big phase 1 base, and we've now broken into a new phase 2 bull market. Now, in markets like bonds, they don't tend to chop and change around on a daily or weekly basis. Once this has moved into a new phase 2 bull market, it will tend to run for a fair while. So that is certainly going to put pressure on liquidity in the stock market. So that's certainly really a key one to watch. Now, the other index that I mentioned is the VIX index. And as you can see, there's really no fear in that market at the moment. We're still trading basically at the bottom of the volatility range. If we pan back and see, you can see the periods when markets get unstable. It happened in 2011. We've had a few little blips here through 2012, but you can see there is actually a trend down to lower and lower volatility. Now, will this eventually break out? I guess at some point it probably will, but if you again shut out the noise, put aside the things that you think should happen and start to focus purely on what is happening, you can see that people really aren't very interested in buying insurance for the stock market at the moment, which just means they're feeling pretty comfortable. Now, turning to the Australian market, the ASX 200 lost 73 points on the week, and if it wasn't for the banks over the week, our market would have done a lot worse. So we're being held up purely by the banks at the moment. The other point I'd make about the Australian market is, and I do a lot of research around individual companies, the field of good opportunities in Australia is getting narrower and narrower. So they're the companies that are really performing well. And that's consistent with the fact that so many sectors of our economy are really up against tough times. So the field of good opportunities is getting narrower, and as a consequence of the fact that there's a smaller number of really good stocks, which all the fund managers are trying to get themselves into, it's very hard to actually get them at or below fair value. So you need to be patient. Those opportunities do come up to buy below fair value, but you just need to be increasingly patient and wait for them. So let's take a look at the Australian sector indices. We'll start off with the Small Ordinaries Index, and then we'll roll it up into the overall ASX 200. So you can see the Small Ordinaries Index is really just tracking sideways. It hasn't really done anything for getting up towards a year now. But equally, it's not exactly breaking down either. There's not lots of big red candles there, and the moving average is flat, and the price is just going either side. So the Small Ordinaries Index really just in neutral mode at the moment. This is the Materials Index, which is heavily BHP, Rio, and Fortescue. So you can see it's doing slightly better than the Small Ordinaries, but not a lot. Moving average pretty flat. Price tended to be a little bit above it, but there's really not a lot happening there. Let's look at the banks. The banks definitely still doing better. You can see the moving average heading higher. The index value tends to spend most of its time comfortably above that moving average. So it's really the banks that are holding us up. Let's look at healthcare. It's doing okay, still in a bit of an uptrend. And let's roll all that up now into the ASX 200, which is looking a bit more like the banks. So that really shows how much more dominant the banks have become in the index than if you go back 4 or 5 years, then stocks like BHP and Rio and Woodside had a much bigger impact on the index. So that's the Australian market. It's obviously just chugging along and following what's happening overseas, underperforming, because if you step back, the S&P index is at its all-time highs, and our index remains nearly 2,000 points below the all-time highs. So our market has definitely underperformed, certainly the American market. Turning now to commodities. The gold price was flat on the week, still in its phase 1 base. Nothing has changed in the last couple of months, and it's a similar situation for the GDX index as well. Silver is still underperforming. It's a bit of a worry because I would have thought silver would have started to have done better than gold, as it always does, because silver is a more leveraged version of the precious metals because it's such a smaller market. The fact that silver is still underperforming tells me that maybe gold is not quite ready to go as yet. So let's have a look at a few charts in that regard. Here's the gold chart. If we take a big picture look, we're still in this big phase 1 base. That I'll look at this. This chart's probably a bit cleaner and a bit clearer. We're still in a big phase 1 base. As you can see, it's between 1180 and 1440. We're sitting roughly in the middle of that phase 1 base at the moment. It's possible that gold could go either way. It could go back down to 1180. What we need to see is gold to break above 1440, and a new bull market is there. Now, from my perspective, whilst this is taking a frustratingly long time to get going, the fundamental drivers for gold to be above $2,000 an ounce absolutely remain in place. If anything, they're stronger than they were a year ago and a year before that, because of the supply-demand situation in the gold market. Just as an aside, China in January and February imported virtually the entire world's production of gold, and you haven't even started thinking about India and all the other countries that are importing gold. So I'm still very bullish on gold long term, but it'll move when it moves, and I believe you should have minimal exposure to gold at the moment. Now this is silver. Silver hasn't done anything yet, and if you pan back and take a big picture look, it's sitting right around key support. And what I'm a little concerned about is that look at all these lower highs. Just put a trend line through there. It's not all that clean, but there is a continuation of lower highs. So the market has been unable to bounce. If this level that it's sitting on now, which is around about the $18.50 to $19 mark, if that breaks, I think we'll see a sharp technical move that could take silver down. There's several levels here, just under $15. There's another one at $12.60, and then ultimately at $9. Now, that would absolutely defy the fundamentals of supply and demand. Silver price should not be down there because the silver market is also pretty tight as well. But the problem with gold and silver is that the prices are being determined by what happens in the paper futures market. And that is a heavily manipulated market. And if the price of silver breaks these lows, I think you could see a very, very sharp move in silver. And maybe that's the washout that we've got to have to really set these markets up to go forward. Finally, let's just have a look at the GDX index. It's just a reflection of what's happening in gold. It's in a big phase 1 base. We really need to see the GDX index close above 3150. Once that's happened, then I think you'll see a major move in gold stocks, and we'll see hundreds of % gain in gold stocks. Moving on to copper, steady at $3.06, and crude still steady around the $100 a barrel mark. This is the price chart of copper. You can see we had a big plunge in March, but it's recovered a little bit and is still sitting just above the $3 mark. So from an overall point of view, the odds on the correction having finished, it's a flip of a coin from my perspective. It's 50-50. I don't know which way it's going to go in the short term. So my recommendation at the moment would be you should be holding at least 30% cash as a minimum, because the odds just aren't great on piling into the market. As I've been saying for some time, just get rid of any speculative and low quality stocks that you've got. Holding on to stocks like that and hoping they're going to come back is just a waste of time. Get rid of them, get your money into good stocks that are going to give you a good possibility of going up in the near term. So your focus should be completely on the best stocks, and if you don't know what that means, then you better find out pretty quick or get someone to help you do it, because that's where the money is to be made. If you're not focusing on the best stocks, then you are gambling. You are not investing in the stock market. You are purely gambling. Gold stocks still in phase 1. I still believe there's a massive potential over the next couple of years, but it's probably not worth moving on them just yet. You should be holding minimal exposure and only the best quality gold stocks. Now, for anyone that is interested in becoming a better trader and investor, I'm always happy to talk to you and help you out if that's appropriate. There's more information about what we do on our website, and if you want to contact me direct, there's my email address. So hope you've enjoyed this longer version. I think markets are pretty interestingly poised at the moment, so it'll be interesting to see how they go over the next few weeks. That's all for now. Cheers.